Greg is 64 years old. He lives in Pennsylvania with his wife Sandra. They saved for 30 years. They did everything right. They had a plan. Then the tariff headlines started. Their portfolio dropped 11% in 2 days. 11%. They panicked. Sandra wanted to sell everything and move to cash. But here's what Greg and Sandra didn't know. While most of the market was falling apart, 5 specific dividend stocks were quietly doing just fine. Some of them actually went up. Today, I'm going to show you exactly which tariff-proof dividend stocks are built for this moment. These are companies that earn almost all their money right here in the U.S., pay reliable dividends, and actually benefit when trade wars heat up. By the end of this video, you'll know the 5-point checklist that separates tariff winners from tariff victims, and you'll see the tax trap that could wipe out your dividend income if you hold these stocks in the wrong account. Quick note, I'm not a financial advisor or government employee. Everything here is for educational purposes only. For your specific situation, always check with a qualified professional. Now let me show you what's actually happening with tariffs right now, because the numbers are bigger than most people realize. The average U.S. tariff rate went from 2.3% to roughly 11% in just 14 months. That's the highest since 1946. The Yale Budget Lab estimates this costs every household $780 to over $1,300 a year. Consumer sentiment just hit 47.6. That's the lowest reading in the entire history of the survey. But here's the thing most people miss. Not every stock suffers the same way. In the first quarter of 2025, the peak of tariff chaos, energy stocks gained 9.3%, utilities gained 4.1%, consumer staples gained 4.6%, while the S&P 500 fell 4.6%. So what made the difference? 5 simple characteristics. The 5-point Tariff Shield. So now you know the tariff picture is bigger than the headlines suggest. But here's the problem. Most people grab the wrong stocks when they try to protect their portfolio. Here's what I mean. A tariff-proof dividend stock has 5 things going for it. Number 1, nearly 100% domestic revenue. If a company earns all its money inside the U.S., retaliatory tariffs from China or Europe don't touch it. Number 2, regulated or contractual pricing power. Utilities and pipeline companies can pass cost increases directly to customers. It's built into their business model. Number 3, essential non-discretionary services. Electricity, wireless, garbage collection. People pay these bills no matter what the economy does. Number 4, foreign competitors hurt by tariffs. When import costs rise, domestic producers get pricing power. Their competitors get more expensive. And number 5, short, localized supply chains. A company that sources everything locally doesn't care what's happening at the ports. Now here's the myth most people believe. Here's the myth. Any company with Made in America stamped on it is tariff-proof. Here's the truth. Domestic manufacturers who import raw materials get crushed by tariffs. Procter & Gamble looks like the safest stock in America, but it estimated $800 million to $1.5 billion in tariff costs. Domestic revenue alone isn't enough. You need the whole checklist. Now that you have the filter, let me show you the 5 stocks that pass every single test, starting with the one that's been raising its dividend longer than most people have been alive. The 5 tariff winners. Stock number 1, Nucor, ticker NUE. Nucor is a 53-year dividend king. That means it has raised its dividend every single year since 1973, through every recession, every crash, every trade war. And right now, Nucor is the single most direct tariff beneficiary in the dividend world. Here's why. Section 232 steel tariffs were doubled to 50% in June 2025. That means imported steel got 50% more expensive overnight. The result? Imported steel share of U.S. consumption dropped from 25% to just 14%. Domestic steel prices surged 35%. And Nucor's CEO said the tariff benefit, and I quote, vastly exceeds any input cost increases. The dividend yield is about 1.3%. That's modest, but the payout ratio is only 30%, meaning the dividend is extremely well covered, and the 5-year growth rate is 6.3%. Now, I'll tell you the risk with Nucor in a minute, because there's a lesson from 2018 that every retiree needs to hear. But first, stock number 2. Stock number 2, Waste Management, ticker WM. Here's a question. What's the most tariff-proof business in America? Garbage collection. Waste Management operates 262 landfills and 339 transfer stations, all in North America. 0 imports, 0 exports, 0 tariff exposure. Your trash gets picked up every week no matter what's happening with China. The company just raised its dividend 14.5% in early 2026. That's the biggest increase in years. The yield is about 1.6%, with 23 consecutive years of increases. The company plans to return 90% of free cash flow to shareholders. An analyst at CIBC called waste companies, quote, particularly well-suited to handle economic uncertainty. I agree. So, you've seen the direct tariff winner and the tariff-immune compounder. But there's a third type of tariff-proof stock, and it pays almost 6%. Stock number 3, Verizon, ticker VZ. Verizon earns roughly 99% of its revenue inside the United States from wireless subscriptions and broadband, services that have nothing to do with imports or exports. The CEO confirmed that a very small portion of their $18 billion annual capital budget is exposed to any tariffs. The dividend yield is 5.9%. The payout ratio is 67%. 22 consecutive years of increases. And here's the number that matters for retirees. The beta is 0.28. That means when the market drops 10%, Verizon historically drops less than 3%. It's one of the steadiest stocks in the S&P 500. And the dividends? They're qualified. That means they're taxed at 0, 15, or 20%, not your ordinary income rate. I'll explain why that matters so much in the next chapter. Stock number 4, NextEra Energy, ticker NEE. NextEra is the world's largest utility by market cap. It's also the largest wind and solar operator in North America. 29 consecutive years of dividend increases. But here's what sets NextEra apart. The average utility grows its dividend about 2% a year. NextEra has averaged 10.1%. That's 5 times faster. For a retiree, that's the difference between your income keeping up with inflation and falling behind. The CEO quantified their total tariff exposure up to $150 million through 2028. That sounds like a lot until you realize their planned capital investment is $75 billion. That's less than 0.2%. The yield is about 2.5%. The payout ratio is 69%. And there's a growing tailwind from data centers and AI, both of which need enormous amounts of electricity. Stock number 5, Enterprise Products Partners, ticker EPD. Enterprise operates 50,000 miles of pipeline across North America. Its business model is simple. It charges fees to move oil, gas, and natural gas liquids through its network. Think of it like a toll road. The toll gets paid whether oil is $30 or $100. 90% of its revenue comes from guaranteed take-or-pay contracts, 26 consecutive years of distribution increases. The yield is 5.9%, covered 1.7 times by distributable cash flow. But here's where it gets interesting. Enterprise has a massive tax advantage and a massive tax trap, and which one you get depends entirely on which account you hold it in. That brings me to the part of this video that could save you or cost you thousands of dollars a year.
Before I show you the tax trap that could wipe out your dividend income, drop a comment right now. Which of these 5 stocks do you already own, or which one are you most interested in? I read every single comment.
So now you've got 5 solid tariff-proof picks. But here's the problem, and it's the one most people don't see coming. Where you hold these stocks matters just as much as which ones you pick. Let me show you 3 traps, and I'll use real numbers so you can see exactly how much they cost. Trap number 1, the IRMAA cliff. IRMAA is a Medicare surcharge. It kicks in based on your income from 2 years ago. For 2026, if a married couple's income crosses $218,000 by even $1, Medicare premiums jump $81.20 per person per month. That's an extra $2,297 a year for the couple. Cross the next tier at $274,000, that's $5,772 a year. Now, think about what happens when you reposition a portfolio into high-yield, tariff-proof dividend stocks. Carol is 67. She shifts $400,000 from growth stocks into dividend payers. The capital gains from selling plus her new dividend income push her $3,000 over the second IRMAA tier. Result? $5,772 in extra Medicare premiums she never saw coming. That wipes out nearly a quarter of her new dividend income. Trap number 2, the MLP trap in your IRA. Remember Enterprise Products Partners, the 5.9% yield? It's structured as an MLP, a master limited partnership. If you hold it in a taxable brokerage account, it's actually one of the most tax-efficient investments you can own. 70 to 90% of your distributions are tax-deferred as return of capital, and your heirs get a stepped-up basis when they inherit it. But put it in an IRA and you could trigger something called UBTI, unrelated business taxable income. If that exceeds $1,000, your IRA has to file its own tax return at trust tax rates, where the 37% bracket kicks in at just $15,200. Bob is 72. He bought Enterprise products in his traditional IRA for the yield. He didn't know his IRA would need to file its own tax return. When he sold his units, depreciation recapture triggered a UBTI event that cost his IRA $2,400. Trap number 3 is ignoring account placement entirely. Qualified dividend stocks like Verizon, NextEra, Nucor, and Waste Management belong in your taxable account. A retired couple with taxable income under $99,000 pays 0 federal tax on qualified dividends. 0. Enterprise Products belongs in a taxable account only, never in an IRA. In a taxable account, it's tax-advantaged. In an IRA, it's a tax nightmare. REITs go in your Roth. Bonds go in your traditional IRA. Get this right, and you could keep thousands of extra dollars every year. Get it wrong, and you're handing money to the IRS and Medicare that you didn't need to. So, these 5 stocks can protect your income from tariffs. But what happens when tariffs go away? Because that's already started to happen, and history tells us exactly what to expect. The 2018 warning every retiree needs to hear. This is the chapter I wish every retirement investor would watch twice. In 2018, steel tariffs were 25%. Nucor's profits surged 80%. Steel Dynamics posted record earnings. U.S. Steel nearly tripled its profits. Then it all reversed. Steel prices rallied to multi-year highs, then fell back to pre-tariff levels by late 2018. The initial spike was driven by panic buying and stockpiling, not real demand. U.S. Steel's revenue dropped nearly 9% in 2019. CNN ran a headline that captured the irony. Quote, "Why American steel stocks plummeted in the past year despite tariffs." And in February 2026, the Supreme Court struck down 60% of the current tariff regime. Nucor dropped 6% in a single morning. So here's the smart move. Don't bet your retirement on tariffs lasting forever. Pick companies that win with tariffs and without them. Look at the 5 stocks we covered. 4 of them, Waste Management, Verizon, NextEra, and Enterprise, don't need tariffs to thrive. They're tariff-proof, not tariff-dependent. The garbage still gets picked up, the wireless bills still get paid, the electricity still flows, the pipelines still collect their tolls. Nucor is the cyclical play. It's the one that benefits most directly from tariffs, but even without tariffs, it's been raising its dividend for 53 straight years. The others, they're the foundation. Tariffs change, tax brackets change, but a company that's raised its dividend for 20 straight years doesn't change who it is. If someone you know is worried about how tariffs are hitting their retirement, send them this video right now. It could save them real money and a lot of stress. What's the one stock in your portfolio you're most worried about with tariffs? Drop it in the comments and I'll tell you what I'd look at. If you're building retirement income and want to stay ahead of changes like this, subscribe to this channel. I cover everything that protects your income, from dividend stocks to Social Security to the tax traps nobody else is talking about. And next time, I'm breaking down the JEPQ tax trap, why the most popular covered call ETF might be costing you more than you think. You don't want to miss that one.